Investor A started with 60,000 monthly SIP and stepped up his SIP by 8% every year. Investor B split the 60,000 monthly savings in two parts, 50,000 for SIP and the remaining 10,000 in an opportunity fund to deploy during crashes. So which investor strategy wins? Let's find out if plain vanilla SIP beats SIP plus lump sum deployment during crashes. The results will really surprise you. But first, please subscribe to the channel. Your subscription and support helps me bring more actionable investing strategies to you every week. In this video, we'll discuss first, which investor strategy is better? Just doing SIP or SIP plus lump sum during crashes? Second, what strategy should you deploy when you get lump sum like FD maturities and bonuses based on two important metrics, PE ratio and earnings? Lastly, step-by-step action plan to build long-term wealth stress-free. Okay, let's dive in. I ran a 10-year backtest comparing two investor strategies. Both investors are disciplined and stepped up their SIPs every year. But both of them followed different strategies. Investor A started with 60,000 monthly SIP and stepped up his SIP by 8% every year. Investor B starts with 50,000 monthly SIP and steps up every year in such a way that he has 10,000 excess left to deploy in his opportunity fund every month. This 10,000 that he has been keeping aside from November 2015 had become a handsome lump sum of 5 lakh by the COVID crash of March 2020, and he deployed this entire opportunity fund in addition to his monthly SIP. Lastly, he smartly also deploys an additional SIP every time the Nifty PE goes below 20x. Now let's compare both investors' final corpus and return percentage after 10 years to see which investor strategy performed better and why. Okay, investor A had invested 1 crore 4 lakh over 10 years, but his final corpus after 10 years became 2 crore 4 lakhs. That is 14.6% compounded annual return. Let's look at investor B now. His total invested amount is 99.5 lakhs. His final corpus comes to 1.99 crores. That is 15.3% compounded annual return. Investor B made higher percentage returns. He also made a smart lump sum deployment during the COVID crash by timing the market perfectly, but still ended up with 5 lakhs less. How? Because investor B kept 10,000 aside every month for 10 years waiting for the perfect opportunity. That's 12 lakhs sitting in liquid funds earning 5 to 6% instead of being in the market compounding at 13-14% annually. Even the perfect deployment during COVID couldn't make up for 10 years of reduced market exposure. The lesson is clear. Time in the market beats timing the market, even when you time it perfectly. We need to have maximum monthly SIPs running based on our long-term goals. Some years the market will be low, some years it will be high. But over the long term, your cost will average out and you'll meet your SIP goal. SIP investing ensures an autopilot approach where you don't need to time anything at all. But the caveat is, you need to keep your SIPs running, irrespective of markets' highs, lows, crash news and speculation around you. Want to see the complete breakdown with exact numbers? I've created a free tracking sheet that shows you how these numbers played out month by month in the last 10 years. It's linked in the pinned comments. Do check it out. Now, does this mean lump sum investing is useless? No, it means most investors are thinking about it completely wrong. The question of lump sum only comes when you suddenly get extra money, which could be through Diwali bonus, annual bonus, FD maturity, inheritance. That's when the lump sum question actually matters. Let me show you the practical way to do it. Here's the time-tested 2-signal deployment framework. Please note this strategy is only applicable for market cap based passive index investing such as Nifty 50, Next 50 and not on stocks or active mutual funds. Since price upon earnings is equal to PE ratio, so price is determined by PE ratio and earnings. In this section, we'll discuss what does high or low PE ratio and earnings growth even mean and how can you independently check them. In the next section, we'll discuss when to deploy lump sum, combining PE and earnings growth metrics in an actionable and practical way. Okay, when extra money lands in your account, check for two things of the market cap index. First signal to check is where is Nifty PE currently. PE represents the sentiment of the market. High PE means investors are willing to pay higher price for per unit of a company's earnings. And low PE means for the same 1 rupee earnings, investors are willing to pay a low price. Historically, Nifty 50's average PE is around 22 to 23 times. And when Nifty 50 index PE is below 20, that means the market is fearful and everyone is scared. This is an opportunity zone for investors. When Nifty 50 index PE is 20 to 25 times, that means the market sentiment is neutral and it's business as usual. But when PE is about 25x, that means that the market sentiment is euphoric. Everyone is making money. This is exactly when we need to be cautious. These ranges are based on historical numbers. So, how can you check the PE ratio of a market index yourself? Simply go to niftyindices.com, then go to reports, historical data, enter the period and download the data. You'll get the day-wise historical PE data for that index. You can compare that day's PE with the historical average to know where the sentiment is. But PE ratio creates a 2 to 3% incremental return at max. Example, if you invested when the PE was 19x and sell when PE was high at 26x, that means that you made 3% incremental returns over 10 years. Hence, investing at low PE does give you opportunity to make a higher return, but only up to 2 to 3% in most cases. Also, only looking at PE can sometimes be misleading. Example, during COVID, when the earnings were depressed, PE shot up to 40x as the earnings had dropped significantly during this period due to COVID lockdown. That brings us to the second signal to check. That is earnings growth of the index. Ideally, an index earnings should increase at the same rate or higher than the country's nominal GDP growth, because the country's GDP is a reflection of how the underlying companies of the index are performing. Currently, India's nominal GDP growth is 8 to 9%. So we'll check index earnings are lower, equal or higher than this. But how do we calculate earnings? Let's do it step by step on our own. Now, as price upon earnings is equal to PE ratio, that means earnings would be equal to price upon PE ratio. That will give you the day-wise earnings level of the index. This is the indicative earnings level. Now, we'll calculate the earnings growth from the previous year. That will give us a picture of whether the index earnings are growing slower or at the same rate than the country's GDP growth rate. Ideally, the earnings growth of Nifty 50 companies should be 1 to 2% higher than the country's GDP growth rate, because these are the top 50 companies of India contributing to the GDP in a massive way. Some years the earnings will be low, some years it will be high, but over the years it should ideally come to 11 to 12% annual growth rate. Earnings growth are the single biggest determinant in driving the index level, because they have the power of compounding the index at 11 to 12% per year. There's a famous saying that market valuations are nothing but a slave of earnings. So far we've discussed SIPs win in the long run and you don't need to time the markets for your long-term goals. Second, lump sum deployment matters when you have sudden windfall money to deploy. Third, two signals to check before deploying are whether PE ratio and earnings growth are high or low. We saw how you can check PE ratio and earnings growth independently. Okay, now based on PE and earnings growth, let's decide what should be our lump sum deployment strategy. Let's look at three different scenarios, taking Nifty 50 index and its valuations as the example. Scenario 1, when Nifty 50 PE is between 20 to 25x and earnings growth is healthy or catching up with the GDP growth rate. That means the market is fairly valued. In this case, I deploy the extra money through monthly SIPs over the next 3 to 6 months. This averages out the cost over market highs and lows. Next, let's look at scenario 2. When Nifty 50 PE is below 20x but earnings growth is healthy, in line or higher than GDP growth. That means this is a sentiment driven correction as PE is low but earnings growth is steady. This is a good investing opportunity but not exceptional. I deploy this money through monthly SIPs over the next 1 to 3 months because PE can increase in the near future. Take this year's 28th February 2025 as an example. PE dropped to 19.6x, but earnings were healthy. If you had received a bonus that time and deployed it over the next 1 to 3 months, you would have captured the 14% rise as PE returned to 22.3x by November 2025. Lastly, let's look at scenario 3, when Nifty 50 PE is below 20x and earnings have collapsed. Earnings is growing at low single digits year over year, and the headline is screaming crisis like pandemic, war, or financial meltdown. This is the time to deploy your entire lump sum immediately. The COVID crash of 23rd March 2020 was exactly this moment. Nifty 50 PE was 17.15x, way below 20x. There was earnings degrowth because the world was under lockdown. Now this was once in a decade perfect storm opportunity. But here's what's critical. These crashes are when you should be investing more and not running away. Most investors do the exact opposite. They panic and stop their SIPs, waiting for clarity. But by the time there's clarity, the opportunity is gone. The COVID example proves it. Even if someone couldn't deploy at the bottom on March 2020 and they invest in April 2020, they would have made 5% higher compounded annual returns till date than someone who had just waited 5 months for clarity and invested in August 2020 instead. Times like COVID feel like the end of the world, and it's not easy to see your previous investment down 40-50%. But we have to fight our natural instincts and double down during this once in a decade opportunity. And no matter what, do not stop your SIPs during this period. So here are the key insights from our comparison of SIP versus SIP plus lump sum. Step 1. Run your core SIPs at maximum capacity based on your long-term goals. Don't reduce your monthly SIP amount to save for a crash. Your SIPs should be as high as you can comfortably afford based on your monthly income and long-term goals. Step 2 is step up your SIPs by 8 to 10% every year as your income grows. This is the single most powerful wealth building habit. Investor A went from 60,000 monthly SIP in year 1 to 1,20,000 monthly SIP in year 10 just through disciplined step ups as his income grew. Step 3. Never stop your SIPs. Not during crashes, not during all-time highs. This is your wealth compounding machine that will grow automatically without any major intervention from your side. Step 4. When extra money comes from bonuses or windfalls, use the 2-signal framework. Check price to earnings ratio and earnings and deploy accordingly. But this is extra money and not money that you've been hoarding for years, waiting for that perfect opportunity. Step 5. Remember that when PE and earnings both collapse, that's your biggest opportunity to invest, not a reason to panic. This is the psychological shift that separates wealth compounders. If you're enjoying this video so far, I have something even more valuable coming up for you. I'm hosting a live webinar on Master Your Money with Goal-Based Investing on 18th January 2026. In this webinar, we'll dive into how to plan SIPs for long-term goals such as retirement, children's education, and financial freedom. how to calculate the right investment amount by factoring in inflation and taxes so you never fall short of your goals, how to build an investing approach that helps you feel stress-free, secure, and confident about your financial future. This will be a practical and action-packed 2-hour session where I will share my goal planning calculator sheet. And we will work on it together live so you can leave with a clear and personalized roadmap. The feedback from my previous webinar was amazing. Please note that this is a paid webinar. The registration link is in the pinned comments. Do check that out. Okay, where are the markets right now? As of November 2025, Nifty PE is at 22.5x, which is the historical average. But earnings, which were growing at low single digits, have started picking up after Q2 25-26 results. So, the markets are neither cheap nor expensive. It seems to be business as usual and fairly priced. If I'd get a bonus now, I'd deploy it through SIPs over the next 3 to 6 months rather than doing a lump sum. But I'd keep my regular SIPs running at full capacity regardless. So tell me in the comments, are you maximizing your SIPs or waiting to deploy at that perfect opportunity? If this video changed how you think about SIP versus lump sum strategy, do hit like, share it with fellow investors, and do subscribe to my channel for more actionable investing insights. Thank you for watching. See you in the next one.